Hey guys, welcome back to the channel. In this video, I'll be sharing 3 Australian ETFs. And unlike the last video where I focused on ETFs that only hold Aussie companies, this time I'll be focusing on ETFs with exclusive exposure to companies in the USA. Companies such as Apple, Google, Tesla, Berkshire Hathaway, and many more. As always, each of these ETFs are low cost and passively managed, and they're all domiciled in Australia for tax purposes. Like my previous videos, I do my best to mention a few different types of ETFs. So in this video we have a small cap, a mid cap, and a large cap ETF. So let's get into it. The first ETF we'll look at is the small cap ETF, and that is the BlackRock S&P Small Cap ETF with the ticker symbol IJR. This is a fund from BlackRock that aims to provide investors with the performance of the S&P Small Cap Index, which is 600 small cap businesses in the US which fall under S&P's criteria. If we look at the S&P Global webpage under this index, we can see they currently hold 601 businesses. Out of all the companies, the highest market cap of any company in the index is around 8.3 billion, and the lowest is 196 million, with the average market cap for the entire index being around 1.6 billion. So on average, the companies in this index are pretty small in terms of size. If we take a look at the holdings, because the fund is full of US small cap companies, pretty much all the businesses in this ETF are businesses I've never heard of. And if you want to check out all 600 holdings yourself, you can go to IJR's webpage and select underlying holdings. For the sector allocation, they have around 18% of the fund in financial companies, 16% in industrials, 13% in IT, 12% in consumer discretionary, and small bits in real estate, energy, materials, and utilities. So this is a pretty diversified portfolio, with holdings spread across all sectors. Now let's move on to the performance. Their performance over the last decade has been outstanding, achieving a massive 16% return every year over the last 10 years. This is partly because of the massive bull market we've been fortunate to have since the '08 crash. There's a great Charlie Munger quote about bull markets, where he talks about a duck sitting in a pond during a downpour, and as the rain keeps falling, the pond's water level keeps rising. But the duck thinks he's the reason he's moving up in the world and not the pond. Because of this recent bull market, pretty much every ETF in the US has been on a rampage, achieving over 15% returns for the last decade. I don't want to burst anyone's bubble here, but these returns are really high and they can't continue forever. It's more likely that the fund will revert to its average performance over the last 20 years, which is around 9% a year since the fund's inception. And even that's not a guarantee, and past performance doesn't indicate future performance whatsoever. Buying a fund because of its recent performance and expecting it to continue is a huge mistake. And if you bought an ARK ETF or the Asia Technology Tigers ETF over the last year like I did, you know the pain I speak of. Both of these ETFs might be great investments over the long term, but if you buy a fund expecting 20 or 30% returns every year, because it did in the past, it's probably not going to end well. Warren Buffett and Charlie Munger are both huge advocates for investors lowering their expectations when it comes to returns, and realizing that 8 or 10% returns are actually solid, and over long periods of compounding can work wonders. So back to the small caps. There's a lot of debate in the investing community about small cap versus large cap ETFs, and which one is better. The general consensus seems to be that small caps tend to be more stable with less growth potential, while small caps will have higher volatility but potentially greater long-term returns. And that large cap stocks suffer from the law of large numbers, which states that a large organization, which is rapidly expanding, cannot maintain its rapid growth indefinitely, whereas when smaller companies expand, a higher growth rate is easier to sustain, with the downside being that smaller companies are more likely to fail and go bankrupt. Historically, from 1926 to 2020, small caps on average outperformed large caps by 1.6%. But to achieve this gain, investors have to tolerate more ups and downs, as small caps usually experience more volatile swings in value. So if you own small cap ETFs, you may or may not outperform a large cap ETF, but you'll almost certainly have more ups and downs. So make sure that's something you're comfortable with before you invest. Lastly, if we look at the fees for IJR, BlackRock charge a fee of 0.07%, or around 7 cents per $100 you have invested, which is nice and low. Alright, the next ETF on the list is the mid cap ETF. And that is the BlackRock S&P Mid Cap ETF with the ticker symbol IJH. This is another ETF from BlackRock, and this one aims to provide investors with the performance of the S&P Mid Cap 400, which is 400 medium-sized businesses in the US. According to S&P Global, the largest market cap of a business in this ETF is around 17 billion, which is pretty large, and the smallest business by market cap is 1.6 billion, with the average company coming in at around 5.5 billion. So on average, the companies are a fair bit bigger than the small caps, but they're still relatively small. If we look at the portfolio itself, pretty much the only company I know that's in the top 10 is Alleghany, and that's only because Berkshire Hathaway bought it out recently. But other than that, there's a bunch of well-known US companies in the fund like Foot Locker, WWE, Victoria's Secret, and Wendy's. And for the fees, BlackRock once again charge a low 0.07% per year, which is the same as the small cap ETF. Overall, this is a good ETF for investors who want exposure to mid-cap stocks in the US. It has a very diversified portfolio of 400 mid-sized companies, and it charges a really low fee. And as far as I'm aware, there aren't any other Australian domiciled ETFs that track the US mid-caps. And the same goes for the small caps too. Alright, moving on, the last ETF on the list today is the large cap. And the one I'll be looking at today is the S&P 500 ETF from State Street, with the ticker symbol SPY. Now, you're probably wondering why I'm using this one and not IVV, which is the BlackRock S&P 500 ETF. Honestly, it's because I've used two BlackRock ETFs already, and I don't want to look like a BlackRock shill. But in all honesty, both ETFs are virtually identical, and BlackRock's ETF is cheaper, so do what you will with that information. So this ETF aims to track the price and yield performance of the S&P 500 index, which is the 500 largest US listed companies across all sectors. The S&P 500 is probably the most popular index in the world, and it's the one Warren Buffett has recommended to most investors his whole life. It gives exposure to the world's most respected and successful companies, and also offers investors access to industries that are absent or poorly represented in Australia, like internet and semiconductors. And by owning a piece of the S&P 500 index, you own approximately 80% of the total US market based on market cap. Alright, if we look inside the portfolio, it contains a who's who list of companies including Apple, Amazon, Google, Tesla, and Berkshire Hathaway, as well as another 490 large cap US businesses. According to S&P Global, the average market cap for companies in this ETF is around 73 billion, which is absolutely massive compared to the previous ETFs on the list. If we look at the performance for SPY, unlike most ETFs which only go back 10 or maybe 15 years, this ETF goes all the way back to 1993, and over the last 29 years, SPY has achieved a 10% return a year, which included a dividend yield of around 1.5%. And finally, if we look at the fees for SPY, State Street charge a fee of 0.094%, which is pretty low, but it's just not as cheap as the BlackRock ETFs. That's not a recommendation, just an observation. Overall, there's not much that needs to be said about an S&P 500 ETF. There's a reason why Warren Buffett recommends it, and there's a reason why it's the most popular ETF in the world today. As always, if you want to know more, always read the fund's product disclosure statement to get all the correct info. So one of the main reasons I chose these three ETFs today was inspired from an article I read about how to mimic the performance of VTS in Australia. For those who don't know, VTS is an ETF from Vanguard that has really low fees. It's a really awesome fund, with over 4,000 large and small US companies, and its performance has been brilliant over the last 10 to 15 years, returning over 15% a year since 2009. It's almost perfect, except the only problem is, it's domiciled in the US. This means that while it may be listed on the ASX, the ETF is based in the US, and therefore you have to deal with both US and Australian tax implications with dividends and such. It's a bit of a pain in the ass, and because of that, a lot of people stay away from VTS, but they wish they had an Aussie alternative. This clever dude named ETF Bloke figured out that if you buy all three ETFs I mentioned, you can get reasonably close to mimicking the VTS portfolio. By owning all three, you essentially own 1,500 stocks compared to over 4,000 for VTS, and you miss out on all the microcap and nanocaps. But because they make up such a small part of the VTS portfolio, you barely notice the difference. As I highlighted before, the S&P 500 takes up around 80% of the total US market, which is what VTS tracks. So by adding the mid-caps and small caps, you end up at nearly 90% equivalent to VTS. So that's my top 3 ETFs that are domiciled in Australia. If you enjoyed the video and you want to support the channel, I'd really appreciate it if you hit that like button. And if you want to see more videos like this one or join our community, then hit that subscribe button. And if you're still interested, I'll put another video up in the corner that I think you'll like. If you've watched the video all the way to the end, thank you so much for watching. And please don't take this video as a buy or sell recommendation for any of these ETFs. I'm just sharing general information for entertainment purposes only. If you're new to investing and you want to learn how I personally invest using the Buffett Munger framework, or if you just want to download and use my intrinsic value spreadsheets, then check out the free course on the channel. As always, this video is not financial advice and I'm not a financial advisor. So please always do your own research before making any investment decisions. So that's it for today. Thank you so much for watching and I'll see you guys in the next one.